I do have concerns around the second half of the year because at that point, if the TGA is drawn down and the Fed's still doing quantitative tightening, if there is some sort of debt ceiling resolution, which you'd have to have at some point, and then the Treasury starts refilling its cash account, that's sucking liquidity out of the system while the Fed is also still doing quantitative tightening. That could be a double negative whammy for liquidity. And so I wouldn't be surprised to see pain ahead. But in order to get to that point, we first have to see how long this debt ceiling impasse goes and how far that TGA cash account does draw down. So that's kind of the flexible framework I'm working with this year, but it's subject to all sorts of change on a kind of a month by month basis.
During a recent interview, Lyn Alden, a highly regarded equity research analyst and investment strategist, shared her thoughts on value investing with a global macro approach that takes into account currency differentials, shifts in monetary policy, and equity valuations. According to Lyn, the Federal Reserve's policy is expected to remain largely unchanged, with the success of tapering being largely dependent on the fiscal policy of the U.S. government. She also highlighted that the choice of policy during the next crisis will be interesting to watch. Lyn draws parallels between the current economic conditions and those of the 1940s and believes that inflation will likely occur in pulses and include periods of deflation. According to Lyn Alden, the aggressive efforts of the Federal Reserve to tighten financial conditions have resulted in a reduction of the record-breaking money supply within the U.S. economy. This may indicate a potential decline in the persistently high inflation that has been observed. Lyn noted that the Federal Reserve generated over $100 billion in net interest income in 2021. Before we proceed with the video, kindly subscribe to our channel and click on the bell icon.
Yeah, I think the long short of it is that, obviously there was massive fiscal stimulus in 2020, 2021, huge burst of broad money around the world with a lag that started to translate into higher prices on aggregate because there was not a uptick in production of goods and services, but there was an uptick in purchasing power of basically at least currency units. And so you had a lot of people going out and buying things and not necessarily a lot available. When you add things like war, geopolitical risks, rising tensions between China and the United States, basically some of this globalization, maybe not going away, but just kind of, not growing the way it was, maybe even pulling back to a certain degree, there's generally more inflationary pressures. And so 2022 was a year of central banks trying to fight back, trying to rein in credit creation, trying to get the air out of excess asset prices, basically increasing the cost of capital so that most valuations compress. A lot of value, a lot of malinvestment gets kind of pushed out of the system. And right now, we're kind of at an inflection point here in 2023 because fiscal policy is still very accommodative. There's still very large deficits kind of flowing into the economy, but central banks are still being kind of aggressive. And I think, one of the risks of a policy mistake is that normally higher interest rates are a way to reduce money creation from bank lending, right? So when we think of the 1970s inflation, that was because there was a demographics boom and banks were lending. They were creating more and more fractional reserve money. And so tighter monetary conditions were a way to try to rein that in. Whereas when, for example, we look back at the 1940s inflation, fewer people are familiar with that time frame. You had inflation that was just as high as the 70s, but that was not due to bank lending. That was due to fiscal spending, obviously on the war. But then that war spending would go back into the economy, and so you had a big up increase in the amount of money in the system, and you got much higher overall inflation, even though banks weren't lending. And basically, we have kind of a 1940 style inflation so far this decade, but central banks are kind of treating it as though it's like a 1970s inflation. And I think this is bound to cause problems in the years ahead. I think if I were to say it overall, I think right now we're in a disinflationary period within what is at risk of being a longer term inflationary decade on average. I think we could get more waves of inflation before this decade is done.
Lyn Alden believes that the Federal Reserve is currently engaging in quantitative tightening to combat inflation, which follows years of massive liquidity injections that began in March 2020. Although U.S. domestic politics are helping to mitigate the impact of this tightening, there is a possibility that the status quo may shift back to the kind of restrictive mood that was observed during Bitcoin's bear market in 2022. There is considerable danger ahead for the second half of 2023, Alden explained. Lyn Alden suggests that the recent surge in Bitcoin's price may be attributed to an enhancement in liquidity conditions, which indicates that there is more capital available for investment. She highlights that Bitcoin's price has a strong correlation with global liquidity indicators, implying that the amount of money available for investment significantly impacts its price. Additionally, she notes that Bitcoin has a historical correlation with global liquidity indicators and is one of the purest liquidity correlations in the market. Therefore, if the price of Bitcoin rises, it directly indicates an increase in available liquidity. Let's listen to Lyn Alden's thoughts as we continue to the video.
Liquidity is not the only measure that affects asset prices, but certainly in the near term. Let's say a typical equity, right? How it performs over 5 years will largely depend on its fundamentals, but how it performs quarter by quarter will largely depend on liquidity and sentiment. And the same is true for macro assets, gold, Bitcoin, certainly other cryptos as well. And so these things are going to bounce around in large part based on liquidity, and that that like a combined domestic liquidity indicator is a pretty good one. And there's three main components, and so we can kind of you know outline what's going to happen with all three of them, right? So the Fed balance sheet is anticipated to keep going down for now. That's basically the Fed's intention to keep reducing their balance sheet, which is negative for liquidity, right? So that's kind of the background direction. Then you have the Treasury General Account. That's basically the Treasury's cash account with the Fed. And this one is inverse, where when it draws down, that's actually good for liquidity. That's pushing money out into the system. Whereas when it increases, it's bad for liquidity because basically it's sucking money out of the system and then just holding it there in this void that's not actually flowing into anything. And the Treasury targets to have around $500 billion just sitting in its cash account. But one of the things that happens during debt ceiling impasses, if it goes all the way to the end, is that one of the things they do when they can't issue more debt is they can draw down their cash account to keep paying their bills until they're able to issue more debt. And so, ironically, in the lead up to a debt ceiling, that could be positive for liquidity because that all that cash is kind of going out into the economy and it's not being refilled.
While Bitcoin has experienced a decline in price from its all-time high over the past year, Lyn Alden remains bullish on the crypto asset in the long run. Alden stated that she is long-term structurally bullish on Bitcoin and considers its fundamentals to be positive. She emphasized that Bitcoin's development serves as an indicator for its fundamentals, citing the Lightning Network, growing market adoption, and other on-chain indicators as providing a more valuable signal than the noise of price volatility. In the past, Bitcoin has exhibited strong performance following across, with average 7 and 30-day returns of 3.8% and 8.3%, respectively. At the beginning of 2023, the price of Bitcoin experienced a 65% drop, which many believed was closely tied to the performance of growth stocks and highly susceptible to rising interest rates. However, even with central bankers raising rates to combat inflation, Bitcoin has shown unexpected resilience, as it managed to recover only 2 months later.
Obviously, when I look at Bitcoin spaces or when I look at crypto spaces, which are increasingly kind of two separate spaces with some degree of overlap, um, basically the Bitcoin people are generally in pretty good spirits. I mean, I was at Pacific Bitcoin, for example, while FTX was happening, and so the Bitcoin price was nuking, the whole industry was nuking, and people were like celebrating and laughing about it, and just kind of just kind of rolling with it. Um, Obviously there's a lot of development happening in the space. People often talk about lack of Bitcoin development, but of course that's mostly base layer focus. There's actually quite a bit of ecosystem development, basically making Bitcoin easier, more accessible, faster, more expressive, things like that on various parts of the ecosystem. As for crypto, I mean, this week was big. I mean, the past couple weeks, there have been a number of people warning about increasing levels of banking system cutting off various crypto entities. And then we've kind of seen the hammer come down on custodial crypto staking from the SEC. Basically, kind of looking at that as like an investment contract that is subject to regulations. I think this has been rather telegraphed since the FTX debacle. That really kind of lit a fire under regulators, gave them a lot more, uh, kind of just coverage to go after certain things. We've also seen a shift in the head of the Commodities Futures Trading Commission. He used to kind of talk about Ethereum being a commodity like Bitcoin. He walked those back in November, those statements back, and kind of would say, okay, Bitcoin's a commodity. We'll see about everything else. We'll leave that to the SEC, which kind of, we kind of know Gary Gensler's view on that whole thing where, Bitcoin, maybe a couple other proof of work coins are kind of commodities in his view, while everything else is at risk of being labeled a security. So I do think we're kind of seeing a shift away from some of these kind of centralized custodians. And I think it's going to disperse globally. I think some of it's going to be muted for a while because it affects how much big capital can go into it. And so I think it's a troubled area, but I think there's going to be future bubbles, future growth cycles in this whole space again.
Lyn Alden predicts that 2023 is more likely to be a year of easing financial conditions than tightening financial conditions, as inflation appears to be decreasing rapidly. The Federal Reserve is approaching the end of its tightening cycle and may even decrease interest rates by the end of the year to support the U.S. economy, which could soon enter a recession. What is your opinion on Lyn Alden's discussion about the performance of Bitcoin and other cryptocurrencies in 2023? Do you anticipate digital assets to perform well in the long run? Share your thoughts in the comment section below. If you enjoyed our content, please give this video a thumbs up and subscribe to our channel.